This is Bazaar Morning Call, broadcasting live from the CNBC TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC TV18 Motilal Oswal studios. Feels like a Monday, but it is not. I'm Prashant Nair, and with me today, my colleagues Surabhi and Nigel. Guys, hi, good morning.
Good morning, Prashant.
Good morning, Prashant. Good morning, Nigel. That's a good one. We're already one day down in the week.
Yeah, but it feels like you're coming out of a
Yes.
weekend, but we're not, which is a good thing because then you're closer to the
Yeah, but it was a great weekend, you know.
three-day long night.
After a long time, yeah.
Well, you know, the market needs to take a bit of a break from all that it is being seen, right? I mean, globally, we've been seeing some turmoil. So let me just actually kick it off exactly there. And we'll start with two-day change because the market today will respond to what happened on Friday. And then we will need to respond to what happened yesterday as well. So the last 2 days, this is the change on your screen. The S&P is down about 0.25%. The Nasdaq is up almost 1%. And the small cap index, the Russell 2000, over these 2 days is down a full 2%. So is there a real takeaway from this? I don't think so. I mean, you know, what complicates the matter is some of the other stuff, right? Now, straight off the bat, the government shutdown did not happen. That's the US government shutdown. The deadline was over the weekend. There was a surprise. It was fast-paced, but it did happen. The next deadline is the 17th of November. So you basically, in the US, have a 45-day stopgap kind of arrangement. And we'll start again talking about, you know, this in the middle of November. But you know, although this is a positive, but I don't think the market in any way was discounting a big risk of a government shutdown or anything. So this should be read as okay. I mean, not a big positive or anything of that sort. What matters is that yields and dollar are once again going in the wrong direction. The 10-year yield, which had fallen significantly from its high of 4.68 to about 4.5354, is basically back up a full 11 basis points last night to 4.68%. That's a new 2007 high. And this is not great news. That's the risk-free rate that we're talking about, the rate around which pretty much all other rates are anchored to. The dollar index, it also hit a new 2023 high. It's now past the 107 level. Again, on the dollar index, I mean, if you actually looked at where the dollar was on Monday, you would have said, well, pretty comfortable. But last night, we saw a 0.75% move higher, and we are above the 107 level. What fueled this at the margin, of course, was data. So you had the US manufacturing data, the ISM manufacturing index, which came through. That came in at 49. The expected number was 47.9. So it was much more, manufacturing in the US, according to this, is much more resilient. And that fueled the higher for longer rates narrative that interest rates in the US will need to be kept at this just under 5% level for much longer than what many thought. So that's the data which came through. But this week, we've got lots of other stuff, right? Important data. So you get more employment data later today. The ISM services number will come out tomorrow. Then we have the claims number, the jobless claims number, followed up on Friday with the non-farm payrolls, the labor market data with the big one, the monthly number, which is on Friday. So I think it's important. The big positive from a global aspect is the sharp drop in oil prices, a 5% sell-off in oil prices last night to just above 90. So oil prices, by the way, are from their recent highs have fallen almost $7-8, which is not small at all. Very, very large fall in a very short time span at 90 now. And I think unambiguously, this is the big positive for a big oil importer like India. Let's tie all of this back, right? So I would say cues from the global markets are mixed. Oil perhaps provides a bit of a buffer because dollar and yields are pushing up, which is not great news at all, not for the stock market, not for the rupee as well. So on the Nifty, if you look at what's happened over the last many trading sessions, all the way from Tuesday last week, the daily range has been broadening. You know, the highs are higher, and sometimes the highs are also lower. Higher highs and lower highs. Basically, it kind of shows you a little bit of indecision. Friday, again, was the inside day, which is we spent the entire session within the previous day's range. The highs, we spent Friday within the highs and lows of Thursday. So not very much in terms of a takeaway. Market came off. It was up almost 200 points. Then it came off, ended about 100 points higher. We need to see if 19,492 which is Thursday's low, can be a bit of a short-term bottom. So it's tentative, but I think that's number one. That's the first task at hand before we go any further. On the upside, you basically need the Nifty to take out the 20-day moving average, and that comes in at 19,786. And I think only above that, once we get a close above that level, can we say that perhaps the worst is behind. Bank Nifty closed in the green on Friday. On the Bank Nifty, we need to see if we can defend the lows, the recent lows of 44,182. I mean, these numbers are not very far away. These are very near-term kind of levels. And resistance for the Nifty Bank, first the 40-day exponential moving average, which comes very close by at 44,824. And then the 20-day moving average, which comes in at 45,034. I think the GIFT Nifty is indicating a slightly lower start. Okay, it's... we started, 19,579 on the GIFT Nifty. We kind of start around some of these support levels. 19,492 is not going to be very far away, which is last Thursday's low. So give it at least the first hour and a half before things start to settle down and you get a bit of a directional idea about what the market wants to do, especially because you're coming out of 3 days holiday. Yesterday was a market holiday, and also because so much is happening on yields, the dollar, and of course that big violent sell-off in oil prices as well. So take the first hour and a half, and don't jump right in one way or the other with what you want to do on the Nifty. Keep some of these near-term levels in mind on both the Nifty and the Bank Nifty. Surabhi.
Prashant, absolutely. But I want to be an optimist, at least as the week when it starts off, and that fall in oil, I think that was music to everybody's ears, right? We're looking at a price below 90, by the way, this morning. So that fall is sustaining. Let's see if that can become a kicker. Otherwise, as Prashant highlights, this is a huge rise in yields. And the dollar, we need to watch for the rupee, by the way. The rupee closed just about at 83 on Friday. But with now the dollar index above 107, that becomes an important trigger and a cue to watch as well. But some more positivity. By the way, a lot of the regional markets are closed for local holidays. There's a China Golden Week holiday that's playing out, so you don't have too many cues there. However, over the weekend, data from China was positive. The PMI number is what I'm talking about. Manufacturing PMI at 50.2 in September. It's the first time since April that Chinese PMI is in expansionary zone. So let's see if metals can react positively to that one Q over here. There's been good macro data in India as well over the weekend. Let's not take away from that. We had the fiscal deficit numbers come in. Now, the deficit has come in at 6.43 lakh crores, which is about 36% of the full year target. It's not too bad. There have been years where we cross 50%, well before the first half is even over. So this is as of till August. The revenue gap in the same period, that's April to August, is actually lower than last year. Tax revenues are extremely buoyant, and that's a good figure to quote. 2.84 is the revenue gap now versus 3.2 lakh crores in the same period last year, April to August. Then we had core sector data come out. That was also showing improvement month on month. The core sector numbers are up 12.1% in the month gone by, August, versus 8.4. And cement and electricity, those numbers are really firing away, the best of the lot in terms of the internals. Finally, auto sales, we'll talk a lot more about that as we go forward. Trends are a little muted. Maruti didn't exactly light up the charts. M&M's SUVs are selling like hotcakes. And the two-wheelers are kind of middling along. So we'll talk more about that. The one negative cue, if you have to sort of pick it out, is a consistent FII selling. And Friday was no different. That's a number that came in about 1,600 crores of net sell. Domestic institutions continue to buy. But I just want to leave this point on the table that the month that closed, September, is the first negative FII month in the last many. Finally, we have a sell figure of about 15,000 crores overall for the whole month versus a deluge of 47,000 kind of crores that we were getting in every month in April, May and June. So FII is selling, but I don't think, Nigel, anyone's complaining because the kind of DI appetite that's out there, it's more than made up for it.
Well, there's a tricky one actually this morning, particularly for the bulls, because the GIFT Nifty is suggesting we pull back 130 points. And if that is the case, we start off in the slot, for the bulls, because you buy near around 19,500, it's been beneficial. Not saying that's going to happen today, but the economic data that you're talking about was fairly positive. And you have the big fall in Brent crude prices as well. So it's going to be a bit of a tricky one. But if you have the appetite, then maybe you keep a bit of a stop loss. And in fact, you go and try to buy it at around 19,500. It was a good start, by the way, to the October series. We were highlighting this on Friday morning, that October traditionally has been a good month. 9 out of 10 times you have positive returns out there. The Nifty, however, when closer on the 20-day MA, we failed to hold on to that mark. So we continue to trade in this range. 19,500 on the downside, 19,800 on the upside. But what's really encouraging is the broader market outperformance. The mid and the small cap indices, you had plenty of stocks that did well even in Friday's trading session. Now, this is, in terms of overnight cues, besides the equity markets, the dollar index continues to march ahead. That's crossed that 107 odd mark. But Brent crude prices have corrected a good $6 odd, just in the last few days. And our markets will take note of that because that was getting a little bit worrying. So let's see how that one goes. There were signs of short covering. Yes, on the index itself, you had both the Nifty as well as the Nifty Bank that came in for a bout of short covering, but not from the FIs because they continue to add some short positions. And now with the addition that we saw in Friday's trading session, close to 4,000 short contracts is what they've added. The positioning goes that the net short positions move up to around 72%. And this is the highest net short positions we've seen in nearly the last 6 months or so. May not be such a bad thing. The global cues are in a bit of a tizzy, but when the FIs go overboard on the short side, that's what gives a bit of a glimmer of hope, particularly when you have them selling in the cash market. What are the levels you're looking at? The recent low, that's the low that we saw on expiry day, closer to around 19,500. That's a crucial level on the downside. We'll hovering around the 50 DMA. On the upside, 20 DMA. That becomes a resistance zone. And also, if we're looking at the Nifty Bank, the recent low has been in that vicinity of around 43,800 to around 44,000. We have bounced out those levels multiple times in September. On the upside, you have the 20 and the 50 DMA that come in at around 45,000 odd. As I said earlier, the gift Nifty suggesting a big pullback. If you're brave enough and if you believe that, this 19,500 will hold out yet again, you're clutching on to good economic data and the fall in Brent crude prices, maybe it will be favorable. But otherwise, the global markets are looking a little bit muddled.
Well, absolutely. They're looking a little muddled and topsy-turvy, aren't they? Before we go any further, let's quickly tell you what's lined up here in the first half hour of the show today. We get you updates from markets across the globe. Ed Yardini of Yardini Research will join in to discuss the global trade setup. Our research team will bring you CNBC TV18's list of top 10 stocks for the day. And at 8:30, we do a quick fundamental stock check with Nischal Maheshwari of Centrum Broking. So that's coming up.
Okay, so we'll get started with all of that in just a bit. But first, the equity call of the morning. Amit Sachdeva of HSBC says India's strong outperformance meets some resistance in the form of rising crude prices, firming US bond yields and risk of inflation. He says mid-cap rallies also warrant some caution and leave large caps relatively more appealing at this juncture and candidates for a potential re-rating. He says their proprietary sector radar points to banks, pharma, retailers, real estate, industrials, auto and telecom sectors as the ones that are still well placed.
Okay, let's get you some money market views. Abhishek Goenka of IFA Global says the dollar's strength triggered by higher US rates coupled with elevated crude prices is resulting in simultaneous stress on both current as well as capital account. He says September was the first month since February when we saw FPIs pulling out money from domestic equities. He adds rupee consequently has been under pressure. Goes on to say that he expects the rupee to trade between 82.4 to 83.7 to the dollar over the medium term.
On bonds, Ajay Magnolia of JM Financial says with the US yields trading around 4.7% levels, traders should avoid any fresh long positions as a holiday truncated week ahead of the MPC rate decision on Friday could keep the new 10-year benchmark bond yield in a range of 7.2 to 7.25% with a selling bias.
Well, we have a lot of stock-specific action to track for you. We get to that in just a bit in our special Top 10 segment. But let's list down the stocks that we're looking at. Vedanta, Ultratech Cement, NMDC, Coal India, Bharti Airtel, IndusInd Bank, Federal Bank, and Suvin Pharma. Well, they are stocks that we're looking at in terms of positive news flow, while Biocon will be the lone stock that will be reacting to negative news flow. And we'll also be reacting to auto stocks, which could react mixed.